Hey everyone, welcome back. Today, we've got a big one. The global energy and commodity markets just had one of the most dramatic weeks of 2025 so far. We're seeing signs of weakening demand, rising inventories, potential supply shortages, and a trade war that's shaking up everything from oil to natural gas to agriculture. Let's break down what's happening, and why it matters more than ever if you're following energy, markets, or even just your next plane ticket. Let's start with oil and travel. US air travel is starting to crack, and fast. According to the TSA, in just the first 8 days of April, air travel throughput in the US fell by 3.5% compared to the same time last year. And it gets worse when you zoom in. Weekday travel, Monday to Thursday, is down 5.5% so far this month. That's a sharp shift considering it had already been sliding through March. Even weekend travel, which had been holding up, is now slipping. It's down 0.4% after showing a modest 2.5% gain in Q1. So what's driving the slowdown? Simple. The trade war. With tariffs escalating and recession fears looming, business travel is being reined in, consumer sentiment is weakening, and airlines are already seeing demand take a hit. And it's not just the US zooming out to global oil inventories, they're rising. Global liquid fuel stocks increased by 9 million barrels last week, with crude accounting for 8 million of that. China's oil inventories were mostly flat overall, but crude oil stockpiles actually climbed by 3 million barrels, which completely offset the drawdown in refined products. This is a classic sign: demand is cooling, and supply is starting to stack up. The data is now closely matching what analysts had been projecting, a slow build in stocks that could snowball if the economic environment deteriorates further. Now let's talk natural gas, and it's messy. US storage levels for natural gas are on track to hit nearly 3.75 trillion cubic feet by the end of October. That sounds good on paper, right? But here's the issue: demand could surprise to the upside. Think higher than expected power demand, extreme weather, or a shortfall in renewables like wind. Even surging demand for LNG from overseas could pull supplies tighter than expected. That's why some analysts are starting to sound the alarm, saying the US natural gas market could face a supply insecurity moment, the same way Europe did a couple of years ago. Especially during this injection season and into next winter. But there's a twist. With Trump's new tariffs and the escalating trade war, recession risk is climbing, and fast. Economists now peg the chance of a US recession this year at around 60%. That makes it really tricky to predict prices. In the end, despite all this noise, analysts raised their 2025 price forecast to $3.80 per MMBtu, about 30 cents higher than before, but still below the current forward curve. There's just too much uncertainty to go further than that. Let's switch gears to agriculture. You might think the trade war would destroy agri markets, but it's more nuanced. US grain exports are still at risk, especially for the 2025-26 crop year. With both the US and China ratcheting up tariffs, the pressure is on to strike a deal before the new crop hits the market in September and October. But here's the good news: China has started pulling back some of its retaliation plans, especially for tariffs over 10%. That's a major win for US agri exporters, and it's led to a bump in the corn price forecast. Analysts now expect 2025 corn prices to average 470 cents per bushel, a 5% upgrade. Why? Because the fundamentals remain solid. US corn balance sheets are getting tighter, and without active retaliation from China, that gives more room for positive sentiment, at least for now. Now, back to oil, specifically, drilling. This week, the US rig count took another hit. The Permian Basin lost 5 rigs, Eagle Ford lost 1, and every other region stayed flat. The Permian has now lost 16 rigs in just 7 weeks, and it's running 18 rigs below forecast. That's bad news for future supply. If rig activity stays at current levels, analysts expect a 62,000 barrel per day shortfall in US liquid production next year compared to previous projections. And for gas? It's a mixed bag. 2 rigs were added in Haynesville, but 2 were pulled from Marcellus and Utica. Net change? 0. Still, it's clear that drillers are nervous, mostly because of weak WTI prices and growing fears of a global slowdown. Let's wrap up with commodity flows. Global open interest in the commodity markets dropped sharply this week, down 7% week over week, or about $114 billion in value. That's a big drop. Why? Simple: energy and metals prices crashed, and precious metals saw massive outflows, almost $29 billion just last week. This happened even after gold was exempted from tariffs. The market is pricing in a recession, hard. With President Trump's surprise Liberation Day tariff package shocking even the most hawkish forecasters, markets are bracing for the worst. Volatility is high, headlines are constant, and major indices like BCOM fell over 7.5% in a single week. It's chaos. So what's the bottom line? The trade war is no longer just a headline, it's starting to reshape real-world demand. Travel is slowing, inventories are rising, and energy prices are slipping under the weight of macro uncertainty. At the same time, cracks are forming on the supply side, from natural gas to the Permian Basin. This is no longer a story about just oil or just trade. It's a multi-front economic battleground, and the next few months could be the tipping point. So stay alert, keep watching the data, and as always, we'll be here to break it all down. Hit that like button, subscribe for more deep dive updates, and let me know in the comments, which part of this story are you most worried about?